What the onset of a rate cutting cycle means for stocks, gold, and silver, a flood of liquidity. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, we welcome back Drew during what has been a very exciting morning after the Fed cut rates by 50 basis points overnight. How are you going, Drew?
Good, Chris. Thanks for having me back on.
Very exciting. Now, some people were predicting that. I think the odds were actually there that it was going to be a 50-point cut, but not everyone really believed it until it happened. And then we've seen a lot of action in the market since. So do you maybe want to start us off today just explaining what did happen there, what the response was? And you were talking about liquidity. Is that what we can expect to see from this going forward?
Yeah, definitely. So the Federal Reserve, the central bank in the US, cut the interest rate by 50 basis points. So that's 0.5%. Now, that's something that we've been expecting to happen for a long time, just following the bond markets, generally looking at macro liquidity cycles as well. So that's very much within expectations. And the markets were expecting that as well. But what was on people's minds was it going to be a 25 basis point cut, 75 basis point cut? But I think really zooming out to the bigger picture, what's important is that we are now on the onset of a cutting cycle. We're no longer holding interest rates high up. And as the cutting cycle continues on, we should expect more liquidity to enter the system, which again is very much in line with our expectations from a timing perspective. So it's nice to see things come together as we were expecting them to.
It certainly is. I mean, we've been excited around the office this morning because we talk about this all the time. And, when you zoom out, it's not a very long time. But when you're living it day to day, it's like, when's something going to happen? When's something going to happen? Then when it does, it happens all at once. Now, in the article, you talked about really that at some point in the future, we move away from this optimistic stage into systemic risk stage. I would argue we're not there yet. This is the start of that cutting cycle after all. But is that is on your mind? Is it something that you're sort of thinking, well, we need to have at least in the back of our mind that in the future, that's where we're going to end up?
Definitely. I think it's quite important if you want to take advantage of market cycles to see where we are, but then have a forward-looking expectation as well. So, we certainly can expect a flood of liquidity to raise all markets together, but what does that lead to? Where are we in the bigger picture? There are a lot of people that are concerned about systemic risks that are on the table at the moment, and these are very real risks. That doesn't mean that we're going to see a collapse today, but just when there's not a lot of liquidity in the system and you can see a lot of systemic risks and markets not doing very well, a lot of people feel like the collapse has to happen right away. But when you get a flood of liquidity and markets start doing really well, and you don't necessarily see that recession come about immediately, people have relatively short memories and they start thinking that the systemic risks have somehow vanished. The mainstream media is not reporting them anymore. They've left the mass consciousness, and people start focusing more on just the asset pricing. So the systemic risks, if anything, will get worse as time goes on, even though liquidity improves. Even though asset prices are going up, the attention should probably not shift away from the cracks in the system that will only get bigger. So while you can take advantage of liquidity, keeping one eye on the systemic issues will help you then move out of risk assets into safe haven assets and just take full advantage of that crisis. Because the article was basically talking about how there is a crisis, but within crisis, there's always opportunity, and how to play that opportunity.
And we were having an excellent discussion yesterday, sort of internally, about exactly this, and the comparisons that you were making were really, I thought, were great, back to the financial crisis as we saw it sort of in 2008, and how, in particular, gold and silver responded. But you were really talking about gold there and how it sort of bounced back quicker and how it played its role quite well. Mm-hmm. But I had a sort of follow-up question for this audience that would be really interested to know. Do you think that the macroeconomic conditions at the moment are really comparable? Because when you sort of played that out to me yesterday, when you were explaining it, you were highlighting that, what would likely happen if we saw something like that. But is that what you're seeing? Is it the inflation, the currency devaluation aspect, all of that? Are they playing into the potential setup for something similar to what we saw in 2008?
Yeah, absolutely. So the comparisons are actually quite freakishly similar to the 2008 crisis. So leading into that, what we saw was all markets rising together more as a product of liquidity rather than productivity of various companies or productivity of land. With increasing liquidity, all markets rose together and systemic cracks in the system got worse and worse. So we started seeing things really not be paid attention to because there was a whole lot of sentiment of greed, euphoria, and complacency. Now, we don't have that quite yet, but what is really similar is liquidity is entering the system and productivity isn't necessarily getting better. So things in terms of where we are right now are very similar, but also our forward-looking expectations will put us in a very similar point to 2006 and 2007 as well.
Right. So we can certainly see those parallels in place that we need to be looking out for. And you're not saying that that's right now, but you're saying that the outcome could end up being similar. And that could line up with our timing as well, sort of into late next year or even potentially into 2026.
Yeah, most definitely. Just things to keep an eye on as you're navigating this phase is what's happening with inflation, what's happening with the bond markets, what's happening with sentiment, and what's happening with asset pricing. So to break each one of those things down, the bond market was essentially front running the interest rate cutting cycle, with the bond yields falling off a cliff starting from October of last year. What we will probably see now is bond yields and interest rates go down together until they flatline, and then you will see bond yields start to increase way ahead of interest rate increases. In terms of inflation, what you should basically be keeping an eye on is inflation starting to reappear. Because as liquidity re-enters the system, what you're going to see is asset price inflation happen basically in real time, but consumer price inflation will take about 18 months to find its way into your day-to-day expenses and things like that.
Yep.
What that means is very similar to what happened in the 70s and the 80s, where you have a tightening period for monetary policy. You then have inflation go down, and then very quickly you have a loosening monetary expansion period. What that means is when inflation reappears, it's sort of like a 1-2 punch, with the second one really being the one that creates the systemic collapses. Because the second round of monetary tightening is not something that the system might be able to deal with or withstand without having some serious resets and serious corrections. So if inflation starts reappearing and we have to go through another round of monetary tightening, that is something that will cause much more long-term devaluations in asset prices. So there's the bond market, there's inflation. And the third thing to really keep an eye on that we might see looking forward is a divergence between sentiment and asset pricing. So what we've seen quite recently in a shorter sort of term is pretty strong asset pricing from a macro technical analysis perspective, but we're seeing very bearish sentiment, a lot of fear in the market, a lot of negativity in the market. So when you see technical structure that is positive and bullish, but then you see sentiment that is fearful, and that can be very clearly recorded as well, you know that it's actually a sign of strength in the markets. When you see the opposite of that in terms of a divergence where you see sentiment that is incredibly positive, but you start seeing technical weakness in asset pricing, you might see 50% levels broken on long-term price moves. You might see lower highs and lower lows set in, or trend lines breaking down. You see greed increasing. You see sentiment becoming more bullish, where people are talking about, now it's time to really go all in. It's time to over leverage. It's time to put all the chips on the table because we're never going to get another opportunity like this again. That is the opposite of the divergence that you'll see now. And so when you start seeing things like that, combined with bond yields going back up, combined with inflation increasing as well, these are clear signs that things have gone now well into the systemic collapse phase as a result of too much liquidity into the system, too much leverage into the system, and asset prices being now overvalued.
And that's certainly something we'll be on the lookout for and reporting back on as that happens in real time. Not there yet, as you've highlighted, but it's really good to be able to identify them ahead of time. Sort of heading towards the end of this and wrapping this up, I just wanted to touch a bit on gold and silver. You mentioned specifically the GSR, the gold-silver ratio in the article, as something that is a key indicator for investors. I know there'll be a lot of people out there really looking to I mean, silver has moved great today. We've had a big move there. The gold certainly did. Uh, what can you say? What do you say to people around silver specifically, and what they should be looking out for in the framework within the framework that you've just provided?
Yeah, so silver is a very interesting asset class coming into this next phase. I'm actually quite excited about it. What you get with silver is a hedge against systemic collapse, similar to gold. You still get your hedge against inflation as well. But what happens with silver is it's a little bit more speculative than gold. So people get into it as a growth asset, trying to get capital growth. So we enter a phase where precious metals, when they're in a secular bull run, basically the phase that we're in right now, or just getting into right now, when you see the masses really believing that bull run in precious metals, that's where silver starts leading the way rather than gold leading the way. You see people piling into silver, and what that means is the gold to silver ratio starts falling off a cliff. So what the gold to silver ratio is basically how many ounces of silver will give you 1 ounce of gold. Now, if silver is leading the way, if gold has gone up, let's say 10% and silver has gone up 20%, that ratio starts to close in. So if it's sitting at about 80 to 85 at the moment, if silver is playing catch up with gold, you're going to see that ratio start going, closer to 70, 60, 50 as silver catches up to gold. So if silver's outperforming gold and leading the way, you're not only getting a hedge against systemic collapse, inflation, and a shelter from the storm, but what you're getting is a incredibly valuable growth asset in that time frame as well. So really what's quite interesting is watching what the gold to silver ratio did during the GFC, where initially when everyone was really scared and there was a lot of fear and markets were genuinely collapsing, everyone piled into gold. Gold started going up, and when the bull run in precious metals became something that entered mass consciousness, silver really started leading the way. And then the gold to silver ratio, after shooting up initially, really fell off a cliff. I think it fell down to about 35. So, we saw a move from about 80 to 35 over a couple of years. So that's an incredible capital growth opportunity that people can find in the midst of broad-based systemic collapses. So if your stock markets are collapsing and your land is collapsing, but you have an asset class that's not only giving you shelter from the storm, but massive capital growth against not only dollars, but against gold as well, I think that's incredibly rare to find and really valuable for people in that. And that comes around a couple of times every generation. So if we're entering this next phase now, silver is something that I'm just incredibly excited about.
And that probably leads into my final question. Obviously, we're going to be biased. That we're looking at gold and silver. We think, and if that explanation is gave, I mean, it's pretty compelling to say there's not really anything else you would look at when you've got something that can offer that protection and that growth. But I have to ask the question, is that the only play? And, we won't hold you to this, but how do you think about that? Are there other asset classes beyond gold and silver you would consider safe havens or that win during that phase of the cycle? Is it really the explanation that you've just given? Like, why would you bother going outside of that? Like, what's your view?
Look, if there is another asset class that can win in that phase of the cycle, I'd love to hear about it. From what I have seen, there simply isn't. The only assets that I can see during that phase that do really well are flight to safety assets, which are monetary metals that have played that role for thousands of years. Entire civilizations have come and gone, and currencies have come and gone, but gold and silver still have value. So what that means is, look, you can get shelter in dollars, in the world reserve currency, potentially US bonds, but I cannot in good conscience recommend someone get into US bonds or US dollars when we're seeing the conclusion of not only a 20-year cycle, but potentially an 80-year cycle. If people have money sitting in bank accounts in US dollars, even if it's earning them, 3 or 4% interest, but your bank collapses, that to me is a risk reward that I'm simply personally not willing to take. So look, I'm quite passionate about the role that gold and silver will play in this next 3 to 6 years. I would love to hear someone recommend an asset class that can do something similar. While dollars will potentially hold their value during times of systemic collapse, I just don't know where you hide those dollars. You can't exactly have them in cash under the mattress either. Looking at potentially coming into a digital currency phase, not having physical money. So with all the broad-based systemic changes that are coming about, an asset that is constant and consistent over millennia is probably the one that I'd personally be looking at over anything else.
And look, that is to me is just such a fantastic answer, because often people we'll go and say, well, you could put it this, put it that, but you really highlighted there that no, you're backing, you have that conviction and you back yourself in that to say ultimately, why would you go anywhere else? And that's a perfectly valid answer, I think, to that question. So really appreciate that. Thank you for all your work on that today, Drew. Really interesting conversation and lots of things to be thinking about going forward on this hopefully very historic day as we start what could be a number of rate cuts to come if it all goes to plan. So thank you for your work on that. We look forward to hearing from you again as we progress down this path.
Thanks so much, Chris. Thanks for having me back on.
Thank you, everyone, for watching. We'll chat again soon.